Well, hi everyone. Welcome to our week 7 video. It's hard to believe that we're in week 7 out of 8 weeks already, but this course is flying by pretty quickly. Thank you for all your work this week on your interactive multimedia discussion board posts. I've been going through those, and everything as always looks really, really good. Everyone's doing a nice job on it. So what I'd like to do is just do a very quick recap of week 6 and then preview week 7 for you, and then wrap up the video with just a couple of housekeeping items just to make sure we're all on the same page and we all know what we're doing as we kind of wind down this class a little bit. So for this week and with this past week in week 6, we looked at obviously taxation. You did your multimedia discussion board posts for me, and those were all very well done. Those will all be reviewed as quickly as I can review them. I'll get some grades posted on those. But we looked at different forms of taxation and looked primarily at the evaluative criteria for those different types of taxes. And in the video that we uploaded for last week, we talked about some of those types of evaluative criteria, whether they be fairness of the tax, burden distribution, determining who pays the tax and how much those individuals pay. We distinguish between progressivity and regressivity of taxation, and highlighted how some taxes tend to be a bit more regressive than other taxes, and it's kind of a contextual decision as to just how progressive or regressive a tax is. As we had talked about before, consumption-based taxes like sales taxes tend to be relatively regressive because of the lack of disposable income from lower income individuals. And so if you don't exempt some of the staples of life with commodity-based exemptions, you're going to end up having a very regressive form of tax. With the income tax, we talked about the attempt to try to make it a little bit more progressive with the marginal tax brackets and the graduated tax system that we use at the federal level as well as here in the state of California. We mentioned that the property tax also tends to be a very regressive type of tax because it's a tax on wealth as opposed to a tax on liquid income. And so we have some taxes that are predisposed to be more regressive in nature, and so therefore we have to manipulate them in order to incorporate circuit breakers into the taxes to make them a little bit more progressive in nature. We talked about some of the push and pull of progressive versus regressive in terms of the nature of the taxes that we looked at. We talked about administrative considerations such as the adequacy of the tax, the collectability of the tax, and we had mentioned that some taxes are very taxpayer passive, whereas other taxes are taxpayer active. The more taxpayer passive the tax, the more collectible the tax tends to be. The more taxpayer active the tax, the less collectible the tax is. And so again, it really depends upon the administrative structure of who collects the tax revenue and where are your points of tax incidence. The more points of tax incidence that you have, the more difficult it will probably be to collect that tax. The fewer points of tax incidence you have, the easier it is to collect the tax. And then we also, in terms of these administrative considerations, also pointed out the two facets of tax effort versus tax capacity. Tax capacity will be the ability of the jurisdiction to pay the tax. Tax effort is the amount of effort that the government puts in to collecting the tax levy that is owed to the government. But by far, the most important evaluative criteria that we focused on in week 6 was the criteria of economic efficiency. And just asking the question of how much distortion a tax has for activity in the economy and just how much this tax may affect demand for a good versus how much the tax may affect the supply for the good. So as we know, there are certain taxes that have a propensity for altering supply and demand curves. And whenever you alter those supply and demand curves, then you end up with these things called deadweight losses. And so whenever you alter the supply and demand curve, that it can affect the production side of the equation. You can have deadweight losses in production, whereby you may actually end up underproducing a good just because you don't have the market signals to enhance production. On the consumption side, you may have a reduced consumption for that good, reduced demand for that good based upon this increased tax rate. That also then can create this deadweight type of loss, only creating it on the consumption as opposed to the production side of the equation. So whether it affects production or consumption, you may have these deadweight losses, which will lead to inefficiency in your taxation. Now, again, the amount of deadweight loss that you're going to have and the amount of inefficiency and distortion you will have will oftentimes be predicated upon the elasticity of that good and just how demand and price elastic that good is. The more demand and price elastic it is, the higher the probability that you will have more distortion in your economy as a result of either imposing that tax or increasing that tax rate. So the takeaway from that discussion of economic efficiency for week 6 was really the contextual nature of economic efficiency in taxation. It really does depend upon the type of tax. It also depends upon how the market will respond to an increase in the price of a good that comes from the imposition of that tax. It depends upon the characteristics of your taxpayers, because there are certainly some taxes that will have more of an impact upon lower income individuals as compared to upper income individuals. So we know that taxes do have differential influences upon taxpayers of differing types of capabilities. So it really becomes very contextual. We have to be very mindful of just what type of impact this tax could potentially have in terms of distorting those supply and demand curves and distorting economic efficiency. So we want to select a tax that hopefully will be insulated well enough from the economy that it will not impact the economy while still generating an adequate amount of revenue. Now, clearly, whenever we try and cut taxes, one of our goals in cutting taxes is to influence the economy. So whereas when you're increasing taxes, you're hoping not to impact the economy too much unless it's a sin or sumptuary tax. When you are reducing tax rates, you are obviously hoping to affect the economy by stimulating economic activity. But again, it's a very contextual decision depending upon the type of tax, depending upon the rate of the increase, depending upon how the market will respond, depending upon the types of taxpayers that you are trying to target. You need to take all of those characteristics into account in determining just how much potential economic distortion there is from either a new tax or an increase in an existing type of tax revenue source. So what that then leads into this week, into week 7. And here in week 7, we are going to drill down on a couple of issues that were presented in week 6. We're going to get into them in a little bit more depth. One of the main areas of focus here in week number 7 will be a focus on personal versus corporate income taxes. And we'll talk more about how personal income taxes work. And we've already foreshadowed that a bit by talking about deductions and exemptions and tax credits and how those types of circuit breakers are used to try and reduce the impact upon certain types of taxpayers. We'll talk about some of the deductions that are also available and exclusions that are available for corporations and the corporate income tax, and kind of talk about how those two types of taxes really function differently and sometimes for different types of purposes. And a type of tax that you think will have a certain type of impact upon an individual taxpayer may have a completely different type of impact upon a corporate taxpayer. So we'll look at some of those differences between personal versus corporate income taxes. We'll also talk about some of the impacts that income taxes can have beyond just distorting our supply and demand curves. One impact that especially a personal income tax increase can have is it may distort what we call in the literature the work-leisure preference, in that individuals may have a certain preference level for work versus leisure. But once you impose an increase in your personal income tax rates, then working more may actually push someone into a higher marginal tax bracket. Once they get pushed into that higher marginal tax bracket, that may actually serve as a disincentive for them to work that extra work and work those additional overtime hours. And so they'll end up choosing leisure when normally, absent that tax increase, they would have chosen work. And so you can see that type of distortion in what we call the work-leisure type of preference. But another impact that we haven't really talked much about in this class from taxes, especially things like income taxes, but other taxes as well, is the practice of tax avoidance. Now, we've always presented in this class that the adequacy of a tax is really contingent upon both the capacity of the jurisdiction as well as the effort that is placed by the government into trying to collect the levy. But the truth of the matter is that your tax capacity is not always perfect. So when you calculate tax capacity, for example, with something like a property tax, a jurisdiction will calculate its tax capacity as the total value of assessed valuation of property within that jurisdiction. So the total assessed value of property within the jurisdiction will give you an indication of the tax capacity of that jurisdiction. Then we'll measure, just how much of a levy is being collected by the government through tax effort, hoping you have at least 97% collection rate of your property tax levy. But the problem is you may have a very healthy tax capacity, but you have trouble collecting that tax. And your tax effort may fall below 97%, primarily because of these strategies for tax avoidance. We know, and we usually in economics, we base most of our assumptions on the idea of rational self-interest, and that individual taxpayers are rational self-interested actors who will try and maximize their benefits while at the same time reducing their costs. But the best way in taxation to maximize your benefits while reducing your costs is to engage in burden shifting, whereby you will shift the burden onto someone else, some other person, some other corporation, some other aspect of society in order to lower the burden of taxation on yourself. We see that burden shifting going on both in what we call forward burden shifting as well as backward burden shifting. And a great example of the difference between backward and forward burden shifting is something like a value-added tax, the VAT. Now, as we had talked about, I think in a previous video, we don't have a VAT here in the US, but a lot of our European counterparts generate a good bit of revenue from a value-added tax. And the value-added tax is where you impose taxation throughout the production process at each point in time when the value of a product increases. So whenever it goes from the raw material phase to the manufacturing phase, that product, by going from raw material to manufacturing, has increased in value. So with a value-added tax, you would then impose taxation at that point. So the manufacturer would have to pay an increased tax on that good at that point in time. Then when the good moves from the manufacturing to the wholesale stage, then you add a tax as well because the value has gone up. The wholesaler then has a responsibility for paying that tax. Then as it moves from the wholesale phase to the retail phase, it increases in value again. So the tax incidence would then be on the retailer. And then whenever the consumer purchases the good, it is increased in value once again. And then there would then be a point of tax incidence on that consumer at the end of the production process. As we know, there's a lot of forward burden shifting, whereby your manufacturer is going to compensate for this additional tax by raising the price and pushing that cost onto the wholesaler. The wholesaler will then do the same thing to the retailer does the same thing to the consumer. And at the end of the day, it actually is the consumer who ends up paying most of the tax because the burden has been shifted forward throughout the production process. That forward burden shifting in the VAT is a great example of tax avoidance. So that's one type of tax avoidance that we see. So if we assume that individual taxpayers and corporations as well are rational self-interested actors, we are going to assume then that they are going to try and push the burden of taxation onto other individuals through several different tax avoidance types of strategies. These tax avoidance strategies and all these efforts to try and avoid taxation tend to increase as tax rates go up. And so as more of a burden is being placed upon these individual taxpayers by government through new taxes or higher tax rates, that is then going to stimulate taxpayers to exert more effort to try and avoid paying those taxes. That's what we know in public administration as the paradox of tighter control. That as you place more controls and more limitations upon individuals, they are then going to exert more effort to try and avoid those limitations. So you think by having more control in a top-down fashion, you'll be able to control those in lower levels, individual taxpayers and such, but you don't, because all you do is stimulate them to try and avoid that tighter control that they're experiencing. It's the same type of thing here with taxation. So the more the taxes they have to face, the higher the tax rates, the more effort they'll put in to trying to engage in tax avoidance. And you'll see as we go through this week 7, one of the areas that you will be looking at, especially with your discussion posts for this week, are some of those tax avoidance strategies and how they work and where they come from. But the more successful taxpayers are at avoiding the tax, less likely you're going to have adequacy in the tax revenue that you are generating. Another example of burden shifting that we see in a lot of our local governments is we see a reliance upon things like transient occupancy taxes, these things called TOTs that we know more commonly as hotel taxes. So if you're a locally elected official and you need to raise some tax revenue, well, it makes sense that you would look to a transient occupancy tax, because those individuals who are paying the TOT typically are not people who are residing within your community, and typically not people who are voting for you when you are up for re-election. And so it's very appealing to use those types of TOTs and hotel taxes, because you are shifting the burden away from your taxpayers, your voters, onto individuals who do not live in your jurisdiction. So we've got lots of different examples of how burden shifting occurs in tax structures, again, based upon this whole principle of being rational, self-interested actors. But we'll cover more of that as we go through week 7. Another focus of this week is we have a chapter that looked at tax reform. Tax reform has been an ongoing struggle for us for the past many decades. And it seems like every session of Congress, we get numerous attempts at trying to reform the tax code. We see the same type of thing at the state level as well. It's a continuing struggle. When we try and change taxes and change tax code, what we oftentimes are trying to do is we're oftentimes trying to stimulate the economy. And most of our changes in terms of tax reform have been changes to reduce the rates, and to at least reduce the rates on sometimes middle to upper income wage earners. And the purpose of that obviously is to try and stimulate the economy. These folks are paying less of their income in taxation, that then frees up more of their income that they could be funneling back into the economy by buying more things, by creating jobs, by starting businesses. And that's this kind of idea of decreasing tax rates for upper income individuals and then allowing those benefits to trickle down. Now, as we know in the Reagan administration, that was trickle down economics, supply side economics, all based upon this principle that we introduced a couple of weeks ago, the Kaldor-Hicks principle, that taxes don't always have to be Pareto optimal. That in the Kaldor-Hicks model, you can actually have some people who are harmed or at least not benefited initially, but that as time goes on, they end up being compensated by those who do benefit. And that's the whole idea of supply side and trickle down economics. With the assumption that reducing tax rates, whenever you reform your tax structure, you reduce tax rates, the assumption that that will then lead to economic growth and higher revenues in the future is something that's known as a dynamic scoring model. And whenever we see tax reforms can be scored on either a dynamic or a static basis. With dynamic scoring, we are saying, well, we are going to get less tax revenue in the near term because we're reducing tax rates, but over time, it'll stimulate the economy and tax revenue will actually increase. Maybe not happen for 3 years or 4 years or 5 years, but at some point in the future, tax revenue will increase, and that future increase in tax revenue will be more than adequate to offset the reduction in tax revenue we're experiencing now as a result of the tax cuts. That's what's called dynamic scoring. Static scoring does not assume that the economy is going to grow as a result of these tax cuts. So with static scoring, you would just score into the future the impact of the tax cut being pretty much equivalent to what you see in year one, in that we're not going to assume that we're going to have any economic stimulation. And this is the area that Democrats and Republicans fight about, and we just saw it in the most recent tax cut, in that the proponents of the tax cut were using dynamic scoring models. Opponents of the tax cut were using static scoring models. And the type of model that you choose will really have an impact upon where you stand on terms of the impact of these reductions in tax rates. So it's an ongoing debate, and usually the proponents of tax cuts are on the dynamic side of the equation. The opponents of tax cuts tend to be on the static side of the equation. Also, whenever we do these tax reform movements, whenever we try and reduce our taxes, we're oftentimes focusing on the locus of tax incidence, meaning we need to determine who will be paying the tax and who will be benefiting the most from these tax cuts. Again, a supply sider, a trickle-down economics adherent would argue that if we reduce taxes for upper-income individuals, that's how we get economic stimulation, and the benefits then trickle down the economic strata. Those who oppose those types of decreases to tax rates for upper-income individuals and would like to see something more progressive, they would make the argument that, well, the trickle-down never really happens. It's nice in theory, but in reality it doesn't happen, because when those upper-income individuals who get those tax cuts, they don't necessarily use that money that's been freed up to stimulate the economy. So we always argue in tax reform about, well, who should be paying the tax? As we had mentioned last week, the locus of tax incidence here in the state of California for the California income tax is disproportionately focused on your top 1% of income in California. So your top 1% of households in California bear the vast majority of the tax burden under our state income tax system. Now, again, that leads to some volatility. Whenever you have a market that's going up and down like crazy, like we're seeing now, gives a lot of volatility and a lot of variability to the amount of tax revenue that California can generate through its income tax. It kind of has this propensity to make the income tax a little bit unstable whenever you have that type of variability. So one focus of tax reform in the past has always been, well, let's change who pays the burden of taxation. And oftentimes it's reducing the burden on upper income individuals for the purpose of economic stimulation. At other times, a lot of these tax reform attempts have really been targeted toward enhancing simplicity. This is what we saw with the huge tax reform bill in 1986, the Tax Reform Act. Tax Reform Act of 1986 was predicated upon trying to simplify the marginal tax brackets and to reduce them down to 3 or 4 major tax brackets, just to make it simpler, to make it easier to understand, to hopefully close a few loopholes. So simplicity is oftentimes a focus. You oftentimes hear members of Congress talk about, well, we want to get the income tax system to the point where you can actually fill out your taxes on a postcard. Well, you can do that if you're not claiming deductions. If you don't have a lot of deductions, you have just, a very simple exemption that you're claiming the standard deduction, you don't have tax credits, you can do your taxes on 1 to 2 pages. It's a relatively simple process. But the fact of the matter is the majority of people have deductions and they have credits and they have multiple exemptions. And so it does become a little bit more complicated. But oftentimes when we do tax reform, we're saying we're doing it to simplify the process and to try and close up some of the loopholes. We also see tax reform done for the express purpose of freeing up capital. And this has to do with capital gains tax cuts. And we hear a lot of talk about, well, we need to reduce the capital gains tax rate because it's too high. And once you reduce the capital gains tax rate, then you're freeing that money up that can then go back into the economy. And again, here there are two schools of thought. One school of thought is with capital gains, you don't want to tax money at the same rate twice. So you have a capital gains tax rate that will be different than the tax rate for earned wages, because those capital gains will be taxed at a lower rate, since you don't want to tax them at the rate that they were taxed at when they were originally earned as wages. So it's kind of that philosophical argument that capital gains should be taxed at a lower rate. The other argument that you see is that, well, sometimes when we tax these capital gains at a lower rate, we are placing trust in these taxpayers that they will take this extra money and they will put it back into the economy. That's not necessarily a given. That if you're paying a 15% capital gains rate as opposed to paying a normal 33%, well, that additional revenue that you get to hold on to, there's not really necessarily a guarantee that you will put that back into the economy. Now, certainly some people do. If you have a private business, you've got your small business, you might turn that money back into your business. You might create jobs, and modernize, and do all those great things. But you're not necessarily guaranteed to do that. That's why the other school of thought is that you have targeted capital gains tax cuts. And by targeting a capital gains tax cut, you add a caveat to the tax cut saying that you receive this tax break if you can demonstrate that this money that you saved, at least a portion of it, went back into the economy. It went back into creating jobs. It went back into creating businesses. And you need to show that and demonstrate that that's where that money went. And that's why they're sometimes considered to be targeted capital gains tax cuts. We've seen both. We've seen whole-scale, across-the-board capital gains tax cuts. We have seen targeted capital gains tax cuts. But oftentimes, those capital gains tax cuts are at the heart of most tax reform legislation. Those tax cuts are meant to try and free up capital, to try and return that capital into the economy, to stimulate the economy, to then increase tax revenue in the future that will be rolling into government coffers. So there's a variety of reasons why we do tax reform. We'll look at some of those reasons for tax reform. We'll look at some of the examples beyond just 1986 and the Tax Reform Act. I believe I have a video up there for you in terms of the newest tax reform bill that was passed by Congress a few months ago, kind of looking at how that functions and how that has some similarities to previous tax reform efforts, but how it also differs as well. So tax reform is kind of another topic, and the last topic that we'll focus on for week number 7. So again, for week 7, we're drilling down a little bit more into the issue of taxation, comparing personal versus corporate income taxation, looking at some of the impacts on taxpayer behavior in terms of tax avoidance types of strategies that people use to reduce their tax burden and to shift the burden onto other individuals. And then some of the tangible ways in which we have tried to reform our tax structure to try and make the tax structure be able to influence and stimulate the economy a little bit better, to try and make our tax structure really focus on the types of taxpayers that we want our structure to focus upon. So those are the primary topics we're going to be looking at for this week. As a reminder, for this week, you have a traditional discussion board posting, and that traditional discussion board posting is text-based. And for this one, what you're doing is you're looking at the tax avoidance strategies that we'll discuss this week and focusing on 3 tax avoidance strategies and kind of discussing how those work and the impact that those strategies may have on the amount of tax revenue that we are able to generate. So that's your discussion board for this week. Also a reminder that course evaluation window opens up on December 9th. So I would strongly encourage you to go ahead and do those course evaluations. They're important for the program to get feedback on the course and the content of the course and how useful the course was for you. I know as a program director over the past 15 years, I find course evaluations to be indispensable. I use course evaluations for staffing decisions, but I also use course evaluations for curricular decisions as well. I can't really tell you the number of times that the feedback that I've gotten for courses in my program, how many times I have used that feedback to then change the curriculum and change the way courses are offered or sequencing of courses and things such as that. So course evaluations, while I know it's an added duty to you, I do ask that you go ahead and do those, because the evaluation is very important for the program and will be used for the program to help develop curriculum in the future. And then the other thing that I want to point out to you before we finish up the video today is the critical assignment. Now, remember that the critical assignment is this kind of culminating type of activity that we have in this class to kind of pull everything together and to kind of let you see how everything fits. So I do recommend that if you haven't started the critical assignment yet, please think about doing so this week. It's a 7 to 10 page assignment. I have all the details for you in week 8. I went ahead and made week 8 available to everyone. I think it was last week or 2 weeks ago. So you had access to it, so you could go and take a look at the assignment and familiarize yourself with it. But essentially, you're selecting a program or a good or a service, and you're answering several questions that I have in the assignment for you that kind of hit on most of the main topics that we covered in this class, so that when you're done with the critical assignment, you have taken a program or a good or a service, and you have kind of followed it through all the critical elements that we have covered in the class. And that's kind of your takeaway culminating activity that we're using for this course. So I would recommend that if you haven't started it yet or haven't taken a look at it, please take a look at it this week. Get started on it this week. And that's, again, a really important way in which we can kind of tie up all the loose ends and make sure that from a competency perspective that you have a good working knowledge of all the major concepts from the course. I know looking at your weekly assignments, I am pretty well convinced that everyone has a good working knowledge of all the topics. Your discussion board media presentations have been excellent. Your written assignments have been excellent. They've really been a joy to read, so I don't have any questions or concerns from that perspective. But it's really nice to have that final culminating activity that not only I can review, but something that you can take with you when you leave the class, so that you can kind of document that you know this information and you can apply this information in a practical and a realistic manner. So I think that's about it for this video. I hope it didn't go on too long, but I hope it was useful for you. I look forward to reading your discussion board posts. And always, if you have any questions at all, feel free to shoot me an email or go ahead and post it in the question and answer link, and I'll be happy to answer any questions you have. So I hope everyone has a very good, productive, and blessed week, and I will talk to you again next week.